Hello everyone, Bill Bush here with Horizon Financial Group. Thanks for being here for today's presentation. The One Big Beautiful Bill, it's now law, and that measure was passed and signed in July. But now that it is law, what does that potentially mean for you, your household, and your business? Well, let's take a few minutes to go over the law, and to do that, we're going to divide this presentation up into small parts. So among them are the individual tax changes, family tax benefits, retiree and senior benefits, estate planning, social programs, and a little bit more. So this presentation provides kind of a high-level overview of what's in the bill and how it can impact you. So our goal here is to help you understand the changes and then plan proactively. So quick history. The big bill was passed in the House back in May. Some revisions were made along the way. The Senate then passed a revised version, which was approved then by the House and was signed into law on July 4th, 2025. So the One Big Beautiful Bill is essentially a follow-up and acted as an expansion on the 2017 Tax Cuts and Jobs Act, or the TCJA you see there. It locks in those lower tax rates permanently. And that means they're no longer set to expire in 2026 like we previously expected. And beyond that, the bill expands deductions for families and seniors, and it introduces new savings vehicles for children and offers some temporary relief for workers, particularly around tips and overtime pay. You probably heard about that. On the other side, it also does trim some federal spending, and we're going to talk about that later as well. So it's important to recognize that not all parts of this bill are created equal. In fact, some things like the lower tax brackets are here to stay, permanent. Others, like the special tax breaks for the tip income and overtime pay, they're only temporary and they are going to sunset after 2028. So as we go through this presentation, keep in mind of which changes are short-term and which are more permanent fixtures, and that'll be key for your long-term planning. So we'll start first with the individual tax changes. So think here your personal or household taxes and how they might be affected. So for many tax filers, this preserves a favorable tax environment. However, projections still matter, especially for Roth conversions, investment incomes, and retirement withdrawals, but the lower tax brackets set to be permanent. Also, the standard deduction is being increased. This larger deduction, it means more income is sheltered from taxes and likely simplifies tax filing for many. So you see 29.2 up to 31.5 for joint filers, 14.6 to 15.750 for those filing single. So this is a meaningful break for many retirees. It could lower taxable income and possibly reduce Medicare premiums or those IRMA brackets, and it expires after 2028, but it is this extra $6,000 per filer, 65 plus. We'll talk about that a little bit more. Also, the alternative minimum tax, there's some relief here that's been made permanent. The new law made the higher exemptions for the AMT, and this simplifies tax planning, reduces the AMT exposure for many middle and upper middle income households, and that's considered permanent relief there. Next category we'll touch on are family tax benefits, and there are two that stand out here. For families, the child tax credit has been temporarily bumped up to $2,200 per qualifying child, and that is up from the previous $2,000. Now, to qualify, your child must have a valid Social Security number, but remember, this increase only lasts through 2028, and then it will revert back with a small adjustment for inflation. This one is getting a lot of attention. The newborn Trump accounts, that's what the bill calls it, Trump accounts for newborns. So every baby born in the U.S. between 2025 and 2028 will get a $1,000 federal deposit to start a savings account. Parents then contribute up to $5,000 a year of their own after-tax contributions, and the funds can be used later for things like college or job training, a first home, or practically anything once the child turns 30. It's an interesting way to kickstart savings for the next generation. These accounts will be set up through the Treasury, and the growth on these will be tax deferred. Now, a lot of unknowns at this point, but more guidance on these type of accounts is expected in the coming months. So what will these changes mean for you? Well, every family's tax situation is a little different. We'll tailor strategies based on age, income, and of course, long-term goals. Flexibility, though, is the key for some of these temporary laws. Let's talk retiree and senior planning and a few items to discuss here. So back to that senior deduction that is available for people age 65 and older. It starts to phase out now once your income crosses the $75,000 mark for single filers and the $150 mark for joint filers. It's designed to help seniors on moderate incomes so that the benefits kind of taper as income increases. And this is one of those that's temporary. This one is going to last from 2025 through 2028. So for clients just under these thresholds, careful planning could help them qualify. Think Roth conversions, realized gains, required minimum distributions, a lot of factors to consider on this. What about the impact on Social Security taxation in IRMA? Well, lowering your taxable income can also help in those ways. Reduces that portion of Social Security that's taxed and maybe possibly avoiding or lowering the income-related Medicare adjustment, those surcharges, which might affect your Medicare premium. So this deduction could give you more than just a lower tax bill. It might actually help reduce some of these other costs. Tax planning moves for retirees. So temporary tax benefits make it a prime opportunity to at least think about some of these things. These moves could lower lifetime taxes and boost net retirement income. So you think of, accelerated Roth conversions, strategic drawdowns rather from taxable accounts, and just the timing of the RMDs. Medicare, MAGI, and marginal tax brackets. Medicare costs, of course, are driven by your modified adjusted gross income, or your MAGI, your MAGI. Even $1 over an IRMA threshold can push you into a higher premium tier, and these new deductions could help you pull under those limits, but it takes some close monitoring. Planning ahead, especially in retirement, can really pay off here. All right, next category is estate and wealth transfer, and we see some permanent relief ahead here. The federal estate tax exemption got bumped up to $15 million per person. That's a big jump from the 13.61, and it'll now be indexed for inflation. But this doesn't mean planning still isn't important, especially for families with real estate, businesses, or assets that could grow. This provision benefits high net worth folks, but fewer estates are going to be taxed federally, but this doesn't eliminate the need for trusts or planning, especially in some states that do have estate taxes. So who benefits? Well, even with a high exemption, estate strategy matters. Planning isn't just about taxes, it's about clarity, control, and kind of passing your values along with your assets. So this includes, evaluating lifetime gifting strategies, maybe setting up trusts, or using charitable bequests to reduce the taxable estate. Trust, gifting, and long-term implications. This is a great time for a beneficiary review and a trust tune-up. Use the temporarily generous exemptions to your advantage. Gift planning remains a powerful tool in 2025. You see the $19,000 per recipient without triggering the tax there. It might also be a good time to consider locking in larger lifetime gifts before the rules change again. These opportunities might not last forever. Estate planning, though, really a shifting landscape. The higher exemption can lead some families to let their guard down. But remember, estate taxes can kick in at lower levels in some states. Federal laws are subject to change. So just a reminder, a solid estate plan should still be a priority, even if you're under that higher mark today. Charitable giving and legacy planning. So charitable giving also impacted here by the tax changes. So donor advised funds, for example, can help lock in today's deduction rules. Charitable remainder trusts, they could be used to provide income, reduce taxes, and leave a legacy. It's all about aligning your giving with your long-term financial goals. Next category, the SALT and tips and overtime, a couple other things as well. And that's what we're going to look at here, starting with the SALT, or the state and local tax deduction. This one considered one of the most contested provisions in the bill. It offers some major relief to residents of high tax states. Note the cap is now raised by $30,000, but does have some income or limit thresholds here and a phase out after $500,000. So this one is temporary relief in that it will expire in 2030 unless somewhere down the road it is extended. But again, that SALT deduction has been raised for now. Tips and overtime pay, temporarily tax-free. This provision could provide some meaningful short-term savings for service workers. Its short lifespan, though, this is 2026 through 2028, makes the timing critical. Businesses and employees should both be aware of this. Eligible individuals can deduct up to $25,000 of their reported tips from their federal adjusted gross income for the tax years 2025 through 28. And this deduction is available to workers in occupations that traditionally receive tips. And again, we do have a phase out here with a modified adjusted gross income of over $150 for single filers, $300 for joint filers. And workers receiving qualified overtime compensation can deduct up to $12,500 single, $25,000 filing jointly from their federal adjusted gross income tax for the years 2025 through 2028. This deduction also subject to some phase outs. Also a new one, auto loan interest deduction. This kind of fulfills a campaign promise, but probably has limited impact for many folks. Still worth mentioning though, if you got a new vehicle that's a purchase is on the horizon, it enables car buyers to deduct up to $10,000 in qualified passenger vehicle loan interest during a given taxable year, beginning with 2025 purchases. Again, American-made vehicles, the full break can only be claimed by single taxpayers with a modified adjusted gross income of $100,000 or less, or married couples with a modified adjusted gross income of $200,000 or less. So again, there are some ceilings there. The QBI deduction made permanent. This is a win for small business owners. This increase helps reduce taxable income significantly, especially when combined with other planning techniques. The QBI, the qualified business income, that deduction now permanent. It's 20% off income from many pass-through businesses. We also saw 100% bonus depreciation come back and full R&D expensing for domestic costs through 2029. This is a win for small business owners, and the increase helps reduce taxable income significantly, especially when combined with other planning. There you see that this would encourage capital investments on the bonus depreciation. Great opportunity for businesses that are looking to refresh equipment or tech infrastructure while being able to deduct that full cost, temporarily applying through 2029. The R&D expensing reinstated, that applies through 2029. Firms that do product development, engineering, or software creation should definitely explore this. It's a valuable but often underused incentive. And then planning tips, what to discuss with your CPA. As a reminder, bring your tax advisor into all these discussions about the legislation that was recently passed. You'll definitely want to make as much use of the provisions that have been passed. Now we move on to social programming, our next category, and some upcoming changes there. Probably heard about some of these. The work requirement for Medicaid has been accelerated, moved up from 2026 to 2020, or rather from 2029 to 2026. This provision reduces federal spending, but may affect family members on Medicaid. The 20-hour weekly work requirement, that applies to only able-bodied adults without young children. And then there's the SNAP and Medicare eligibility restrictions. Again, some controversial cuts here. It does disproportionately affect lower income and immigrant households. The SNAP benefits now require parents to work unless their child is under 7. Medicare access restrictions, despite having paid taxes, that's the legal immigrants. Maybe they've been paying into the system for a while, potential ramifications there. And this does reflect kind of a shift toward tightening income-based aid. So who's affected and what does it mean? Well, the big picture here is the wealthier families might benefit from the expanded estate and tax relief. But again, some of the lower income households that these support programs, they're being scaled back. So if your household or someone in your care relies on those programs, now's the time to assess the ability, the eligibility, and make preparations for that. Overall fiscal impact on the bill that's now the law, that's our final category. So how are these things going to affect the budget, deficit, etc.? Well, the level of tax relief and borrowing raises long-term concerns, of course. Future tax increases or spending cuts may be needed. And, as the Congressional Budget Office projects, $2.4 trillion in new debt over 10 years. And they have increased the debt ceiling as well as a measure of this proposal passing. And then final guidance, I would just say that what should you do as a result of the bill passing? Well, we notice most of the proactive clients tend to achieve the best outcomes. So a few action items to consider. Review your tax projections for 2025 and beyond. Evaluate your deductions, credits, and estate plans. Talk with your advisor before the year ends. And then let's just get together. If you have goals, among them preserving your wealth, reducing taxes, and aligning your plan with life, reach out to us, schedule a time, be glad to meet you. And of course, stay informed. A lot of our goal is to stay ahead of all the strategy that's being passed, but tax law has changed for now. So you got to be proactive, stay ahead of it so you can remain optimized, protected, and of course, confident as you go ahead. Well, that's a quick look into the presentation. Thanks for joining us. If you have any questions about anything you saw here today, feel free to reach out to us at info@horizonfg.com. Drop us an email. Again, thanks for watching, and we'll see you soon.